Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video, we are looking at 3 different cybersecurity companies. Cybersecurity has grown in popularity as the race to digitization and technological advancements requires protecting vital information, networks and programs from digital hackers. These hackers are becoming very sophisticated, so these companies have to build software that actually helps them to protect that. Okay, and the 3 companies we're going to talk about today are used by all sorts of worldwide companies to protect their data, networks, as well as, of course, programs and so on. So what I want to do first is share with you the 3 companies. Again, of course, if you're interested in these companies, do your research, find out a bit more information. Don't just take my word for it. But before we do that, as usual, give the video a like, subscribe to the channel. Let me know if you have any questions. Like I've always said to you guys, there's about 50% of you guys that have not subscribed to the channel yet that are watching the videos regularly. So please, that would be really genuinely helpful if you could do that, as well as, of course, joining us on the Patreon account, where you've got access to quite a lot of things. You got the daily watch list where we update regularly, all the stocks that are in that watch list. We have the ETF trackers, we got the private Discord, we have all the buys and sells, the stocks that I'm making, which I share on the Patreon account. So it will be fun if you can join us. That would be really great, and it will definitely help the channel go a long way. Right, so the first company we're going to look at today is Fortinet. This company is a cybersecurity solutions to provides cybersecurity solutions to a variety of businesses such as enterprises, communication services providers, and small businesses. Now, it has a market cap of almost $40 billion right now, and current price is $50 per share. EPS right now, it has a positive EPS of $1.45. Some of these companies do not have a positive EPS, so you have to take that into consideration, meaning the company is still losing money because they are growth companies. They're still on that trajectory of basically becoming a profitable businesses. Okay, it has a wide economic mode, and beta is actually not bad for this type of business. Current PE, we're looking about 34. Let's call it 35. The forward PE is, however, it's about 32. The sector right now is 35, and the S&P 500 is about 24 right now. Now, the 5-year average for this company, for the EPS for the last 5 years, we're looking about 55 PE. So for that reason, it actually seems a bit cheap. Price to free cash flow right now, we're looking about 20, and PEG ratio just below 2. Normally what we're looking for is below 1 is very cheap and so on. 2 is actually not bad. Anything below 2 is actually okayish, so there might be some value in this. Okay, right now we're looking at free cash flow of almost about $2 billion, which is quite nice because these companies actually burn a lot of money. They actually go to the bank, borrow a lot of money. The reason these companies went down where interest rates go up is because they still on that phase of like building their business, so they need cash, and sometimes that cash comes from basically the banks and they're borrowing money. So when the interest rates were 0, they were able to basically get a lot of money and then use that to build their portfolio products. Now, sometimes they dilute our shares to actually sell more shares, or dilute it and basically giving us more shares. And for that reason, they raise money through that, which is absolutely fine for growth companies. Free cash flow margin right now is 40%, and free cash flow yield right now is 5.3%, which is absolutely good. Profitability is actually not bad for this company. They're profitable, so they right now profit margin, we're looking at about 22%, operating margins of 23%, return on equity 843, total return the last 10 years we're looking at about 29%, and the return on invested capital of 100, and basically let's call it 108%. In terms of revenue in the last 5 years, we're looking at about 24%. Okay, current ratio above 1, which is absolutely fine. In terms of growth for the next year, they're expecting the earnings to grow about 8% next year, and then about 16% every year after that. Current price we've already seen is $50 per share. Fair value for simply Wall Street is right now $84 per share, which means it's undervalued about almost 40%. According to Morningstar, it's basically $60 per share. That's fairly valued at the moment. TipRank is saying for the next 12 months, it should be about $57 per share, which is about 12% from where it is. It's a moderate buy. Similar situation with Seeking Alpha, and they're also saying it's a buy. Now, in terms of Sharia compliance side of it, there's no issues, okay? and they have been buying back their own shares in the last basically couple of years, which is quite nice. So this company has now, it looks like it's kind of stabilizing. They are profitable business, so we will see how they scale their business and so on, but it seems that basically it's in a good spot right now. So they're still not growing 40-50% in every single year, so they kind of slowing down a little bit, but at the same time growing about double digits, which is quite nice for the next 5 years, every year for the next 5 years, which is quite nice, right? So that's the first one. The second one is CrowdStrike, another one that I've spoken about in before. Similar sort of products, okay, but it offers basically cloud delivered protection across endpoints. So they don't have actual physical basically hardware they install. Mainly basically they protect stuff, the software and applications and all of that stuff from their end side of it, so from the cloud delivered protection access points. Now currently they have $204 per share. EPS is still negative, so they are not actually making profit right now. 48 billion market cap, let's call it 49 billion. Narrow economic mode, and beta is less than 1. I thought this company used to have a wide economic. I need to check Morningstar again, but definitely right now is a narrow economic. Maybe they've changed that. It will be interesting to see. There's no PE right now because there's no earnings part. So the earnings, the E part is not there at the moment. Okay, so there's a price, but there's no earnings. So forward though, 72 PE, the 5-year average 310, price to free cash flow 60, and PEG ratio below 2. And then again, same thing for this sector. Okay, free cash flow right now just closed below $1 billion. Free cash flow margin of 30 and free cash flow yield of 1.7. In terms of profitability, it's not there at the moment, but the revenue grew in the last basically 5 years about 80%, compounded annual growth rate of 80%. This is probably why a lot of people are basically paying higher multiples for this company right now, because of that massive growth. Now next year they're expecting the earnings to grow about 25% and then 40% every single year after that. Again, this is why people are paying those higher multiples. Current ratio price, we're looking about 204. In terms of simply Wall Street, they're saying it's about 27% undervalued at the moment, so their price target is 280. Morningstar is actually saying it's the opposite, 25% overvalued at the moment, $163 per share is where they think the price should be. TipRank is actually saying 3% downside from here onwards, but it's a strong buy. They both said it's a strong buy, but 3%, it should come down about 3% basically. That's their price target is on basically below $200 per share right now. So it's an interesting position right now. I think I would definitely agree with Morningstar and say it is overvalued at the moment. I wouldn't touch it. I've seen this company go up $110 per share not long ago. So it's very, very volatile stock. Right now, in terms of business activity from Sharia compliance side of things, according to Zoya, is 97%. Basically, halal right now. Interest-bearing security, we look interest-bearing debt of 2%, interest-bearing security of 8%, and they are of course diluting your shares. Of course they have to. The company are not making money, and right now is not a good time to go to the bank and get more money. So what are they doing? They actually issue more shares so they can actually pay off and basically grow the business, and that's absolutely fine. If this company is doing, this is what's expected from the company, and of course they have to finance that growth, then it doesn't matter. So it's still at that stage of basically diluting your shares, but maybe in a couple of years down the line that will change. The final company that we're going to talk about is Zscaler. This company is exactly the same, more or less, the two other companies that we talked about. Provision for cloud-based internet security platform. So that's their main specialist. So they engage in the provision of a cloud-based internet security platforms. They've got loads of different platforms they used in basically across the internet. Right now their market cap is $27 billion, so they're not really a huge company. They are slightly smaller than the other two. Current price of $186 per share, and again they're losing money right now. Okay, so they're still in that growth phase. They have a narrow economic mode, and beta is actually quite low. The PE doesn't exist, but forward PE is about 83, 5-year average of 349, and price to free cash flow right now about 81 and so on. PEG ratio again less than 2, and free cash flow right now Yeah, 333 million right now. Free cash flow margin of 21% and free cash flow yield of just below and above 1%. Now, in terms of profitability, like we've said for the other one, CrowdStrike is not actually there yet, but revenue growth in terms of the last 5 years, about 54%. Current ratio covers the current liabilities and doubles almost. And the next year, they're expecting the earnings to grow about 26%, 47% or 48% every year after that. So that's probably one of the reasons why people are paying those higher multiples. Current price we've already seen, according to Simply Wall Street, is saying is about 30% discounted right now. $266 per share is where they think the price should be. According to Morningstar, is actually saying it's fairly valued, 183. So it's about 186 right now. So it's fairly valued right now. Tiprak is saying basically about 2% upside from here. So strong buy, about 2% upside from here for Seeking Alpha, and they're saying it's also a buy. This one, for some whatever reason, I think they have a lot of interest that they generate, and basically they're paying a lot of interest, I think, right now. So 96% is their overall Sharia compliance side of things. If you're interested, definitely look into the company's business and see where this cut is coming from, because this can easily become the 5% limit. Interest-bearing debt is 5% right now, and interest-bearing securities is about 9%. And of course, they are also diluting your shares, because again, that, like I said earlier, that's how they grow their business. Now, there you have it. That's the 3 companies that I wanted to share with you guys. In my opinion, out of the 3, this is probably the one I would actually give higher rating over the other 2, and the reason is because they're profitable. They've been around quite some time. We use some of their business, but some of their security side of things, and I know they're really quite good. There's a lot of companies that use it. It used to be between, for me, it used to be CrowdStrike, this one, or Palo Alto Networks. And I sold Palo Alto Networks for a reason, and this is the one I'm now looking at, thinking maybe potentially if it comes down. I'm not initiating a new buy anytime soon, but if it comes back down, maybe to the fair value just below this 50, maybe 45 or below. And I've seen that, to be honest with you, I've seen it go down to 30, I think, at one point. Okay, but when they reported their earnings, so it'll be interesting to see. Even Palo Alto Networks, I think, was down yesterday 5% because of Cisco being down almost to 12% at some point. So you might get an opportunity. Okay, so all I'm saying is, don't take my word for it. Of course, do your own research. But if I had to pick one out of the 3, it will be this one, and this is probably the one I'm going to add to my watch list and keep watching, inshallah, in the next few months and see what happens. There you have it. That's the 3 companies that I wanted to share with you guys. If you haven't joined us in the Patreon account and the Discord, okay, please join us, and that would be really helpful for the channel. And as always, I'm going to do a few more videos. As you can see, the portfolio is doing really well right now, almost up 6%, or almost £450, £4,500 right now. Got some dividends and so on that I want to share with you guys. So I've got a few more videos planned for the rest of the weekend, inshallah, coming. So I will share that with you as soon as I finish. Have a wonderful day. Assalamu Alaikum.